The way a company is financed can determine its success or failure. Capital structure is crucial. It refers to the mix of debt and equity funding a company. A good structure supports growth. A poor one can cause instability. It's like a house's foundation. Weak foundations lead to collapse. It impacts risk and profitability. Too much debt is risky. Solely equity can limit growth. Balance is key for sustainability. Companies can choose from various sources of capital. Equity financing involves selling ownership shares. This dilutes ownership but avoids debt. Debt financing involves borrowing money with interest. Debt can be cheaper but increases risk. Hybrid financing combines equity and debt. Convertible bonds can convert debt to equity. Understanding each type is essential for an optimal capital structure. Attracting investors often requires offering competitive terms. However, overly aggressive credit terms can backfire, jeopardizing a company's financial health. High interest rates on debt can strain cash flow, leaving less room for operational expenses and growth investments. Some investors may demand warrants or other sweeteners that dilute equity and reduce shareholder value. Before accepting any financing, companies must carefully assess the long-term implications of the terms. This includes modeling different interest rate scenarios, understanding potential equity dilution, and evaluating the impact on key financial ratios. Remember, short-term gains from easily obtained capital can lead to long-term pain. Finding investors is only half the battle. Aligning investor goals with the company's vision is crucial for growth. Different investors have different expectations and risk appetites. Conflicts arise if investors prioritize short-term profits. Open communication and clear governance are essential. Companies should engage with investors, providing updates and seeking input. Building strong relationships fosters trust and collaboration. A balanced capital structure and strong investor relationships are key.